Hi, my name is Jay. I have a background in economics, equity derivative trading, wealth management, and geopolitical analysis. I'm an investor and an unrepentant capitalist. I do this because I love it. There's nothing else I would rather do than follow global markets. It's the greatest show on earth. I wouldn't characterize myself as an expert in any particular area, but rather as a generalist with a good amount of knowledge in a variety of areas. I do my own equity research. I monitor options, order flow, and keep track of real time breaking news on X. I have personal connections in banking, American venture capital, the American and European media at big tech, and inside the Trump administration. I've traveled the world extensively. I do not work for any intelligence agency, and I am not paid by any third party. I make my living as an investor, and again, I just do this because I love it. So professionally, I used to do geopolitical analysis for a private firm. I covered events like the Assad chemical weapons attack in Syria, the dengue fever outbreak in Southeast Asia, the war in Afghanistan, and many other geopolitical conflicts and events like these. I navigated the tariff crisis last year successfully to return over 120% for the year in my personal trading account. And I did 105% the previous year in 2024, primarily driven by Palantir. But so far for this year, I'm 15% up in a flat to slightly negative market, which has been challenging and difficult to navigate in this shop. I mean, it's been couple months of just going sideways at this point. But anyway, the purpose of this stream is to be a series for my research newsletter called Altius Research, Altius research.com. It's completely free. I just send out email alerts for my highest conviction equity and derivative trade ideas. I definitely will not spam you. I only send out one email a month, if that. I typically hold my positions for at least a couple months. I mean, years for many of them. And sometimes there'll be months where I don't send out anything. So don't feel like you're going to get spammed because I won't do that. And I just want to make clear this is not investment advice. These are just my personal high conviction trade ideas. And I also wanted to announce that I'll be expanding Altius Research to cover prediction markets as well. So if you see some emails that aren't purely equity research, they might be for prediction markets too. Okay, so let's get into it. I wanted to start with a brief market overview. So I'm just on Bloomberg now looking at sector performance for today. I don't know if I'll do this every day, but hopefully a couple times a week. Obviously, energy was up today, tied to the oil crisis in Iran. But it's really just uncertainty that's driving that. Oil traded up all day. I watched it all day. It and SPY and the Qs just went inverse oil all day long. So I saw in the last hour, it seemed like the Trump administration tried to save the market a little bit and provide a little bit of a floor. They sent Scott Bessent out, and he said that he wants an international coalition to protect ships to cross the strait. And the purpose of that would be to put the Iranians in a position where they had to attack everyone uh, in order to prevent ships from passing. So I don't know if that will actually work. But again, I think it's just uncertainty that's driving this move down. And I think the other thing is that it really hasn't sold off too much yet either. Like the move is fairly telegraphed, and but by that I mean people have hedged. I mean, you could look up indicators for this, but I don't want to get too technical yet. But even in my personal portfolio, I've had a significant percentage in puts that I've just held to hedge against something like this. And every time the market goes down, it's an opportunity for people to cash in their puts, and then that just forces more buying. So I think that's why you haven't seen like a vicious sell off yet. Um, but yeah, I mean, looking at like tech was down almost 2% today, so that's a brutal day. And I mean, if you really look at it, it's like tech makes up such a significant percentage of the S&P 500 that I mainly look at SPY and QQQ. So let's focus on QQQ for now. And if you don't use any charting software, you should sign up for an account at tradingview.com. and you could put in a couple indicators there for free. I think it's only paid if you put like five or more indicators. But you should be looking at the nine SMA, nine simple moving average, 21 simple moving average, 50, 100, 200. Those are the main ones that traders follow. So at this point, we are breaking down in QQQ and SPY and almost at the 200-day moving average. And if you don't know too much about investing, typically buying at the 200-day moving average historically has been a great move, as long as you're in it for the long term. But that doesn't mean that the 200-day moving average always holds. You just have to think longer term about it. So, for example, last year when we crashed in April, we flew through the 200-day moving average. So the Qs were at 540 was the high in February of last year, and then by March, the 200-day moving average was at 490, and we came all the way down to 400 by April. So these moving averages don't always hold. So you have to know that. But it's important to pay attention when you're slicing through moving averages on the way down and when you're breaking through them on the way up. So the top on the Qs 2 months ago was about 640, and then we came through the 9, through the 21, through the 50, through the 100, and now we're approaching the 200-day. Like we're almost there. The 200-day is at 590, and we're at 597 right now. So it wouldn't surprise me tomorrow if we hit 590 on QQQ. And if we do hit that, either they'll try to hold it there or they'll break it through viciously. And you should be prepared for either of those to happen. The thing for me right now, though, is I just don't see too many names that I'm too excited about buying. So, like normally at the 200-day moving average, I would love to be adding to names that I had a high conviction in. But yeah, I don't know. I think a lot of stuff is highly valued, and we haven't really come down enough, especially in individual names that I'm interested in to justify um, making more or make to justify buying more stock here. Um, but the other thing is it's not just oil with the Strait of Hormuz. I don't know if they were. I didn't watch CNBC today. I normally don't, so I'm not sure if they were talking about this. But it's not just oil that comes through that strait. There's other things like helium, and helium is really important for a lot of the tech companies in Asia, for a lot of the hardware companies. So like the memory companies in South Korea and even Taiwan. So I think TSMC was down significantly today. I was looking at that at the open, and I thought I would love to buy puts on it, but it was already down like over 4.5% on the day, and the premiums were so high that I just didn't do it. But that's another one. If you look at the chart for TSM, I mean, it's had an incredible run, and it's just like even if you're waiting for a pullback, it's just nowhere near worth it in my opinion. So last April, TSMC was $134. The peak last month was 390. So I mean that's a ridiculous run. And it's still at 336 right now, and it just broke through the 50-day moving average on the way down today. Um, but there's a lot of charts like that, especially within tech that haven't even hit their 100-day moving average, let alone the 200-day moving average. Google's another one. Google's sitting right at the 100-day right now, and the 200 is a long way down from here on Google. But Google's been one of the big leaders this cycle. So yeah, it's not just oil that comes from that straight. There's other things too, and it wouldn't surprise me if you start to see tech start to roll over if it continues to be an issue and they can't sort it out politically. But like the things that would worry me is if you start seeing TSM or SK Hynix or some of these other memory companies start to express concern about meeting production. So I would keep an eye out for that. I mean, I haven't seen anything like that yet, but I don't know how much inventory they have of these types of materials that they need. But I saw something that said they have about 1 or 2 months. So maybe they're just keeping quiet for now and hoping that it gets worked out. But I would definitely keep an eye out for that. And if you do think that we're going to see more downside, I would look at TSM, Intel, or some of these other semiconductor and memory companies specifically tied to the Asia supply chain that could be affected by this, where it seems that shoe hasn't dropped yet. The other thing that I'm also concerned about at this point is private credit. I've been talking about this for like a month or so on Twitter. I've seen people suggest that private credit is such a good opportunity, but I mean, we're just not seeing that in markets right now. I mean, I first thought that there would be a problem in private credit when I saw them advertising it for personal retirement accounts. And I mean, my thought was when I saw that, I thought, okay, they're trying to offload the risk liability onto the American public retirement accounts, just in case they need a bailout, because that would effectively guarantee a bailout. Like they're not going to let pension funds or retirement accounts go down because of a collapse in private credit, in which case the government would step in and save it. And I don't know if that's going to be necessary in this case, but just to give you an idea, um, just over the last couple weeks, I've seen halting of redemptions in private credit. So today, Cliffwater capped redemptions at 7% on a $33 billion fund. Blackstone capped redemptions at 5%. Um, what was it, a couple days ago? I think that was. And Morgan Stanley and Blue Owl also took similar actions in their private credit funds. And Blue Owl is one of the worst ones. I mean, if you look at that, and I think they're involved in a lot of the data center buildouts. But I mean, if you look at that chart, they went from $27 last January, and they're all the way down to $8.6 now. So I mean, that one is highly concerning. Um, and the reason that that private credit is concerning is because if they have to cap their redemptions, they do that to prevent the forced sale of assets. And that's concerning because a lot of these private credit funds are financing the build out of the future of the American economy. So that's namely AI and data centers, which are extremely capital intensive industries. And if financing dries up for that, future growth projections will have to be cut. So, yeah, I'm watching Blue Owl and Blackstone pretty closely for that. Yeah, I mean, Blackstone went from 200 to 100 in a couple months. So I mean, that's like a pretty shocking move really quick. Um, so I mean, hopefully we just start to see some good news come out of that sector. But honestly, I can't even imagine what good news comes out of there. I know Oracle is tied into that as well with a lot of their data center financing, and they had a good earnings report that the market liked a couple days ago. And they got a big bounce on that, thankfully. But even with that, private credit hasn't gotten a bounce, so I still think that's a highly concerning sign. And Oracle even gave up half of that move over the last couple days. Um, but I don't think there's any risk that something like Oracle would go under. I mean, I think they would save it if they had to, and I think the people at Oracle are competent enough to get the financing situation under control. And it seems like it's just going to take some time for that to happen. But as far as these other smaller private credit funds go, I don't know. I'm not an expert in that area, but it just seems like the news keeps getting worse, and I just hope it doesn't continue that way. But like I said, I can't imagine what could save it at this point, or what positive catalysts there could be. I mean, I guess fundamentally, we just need to see more growth in AI and data centers, and particularly in revenue. Because I mean, that's fundamentally the issue with OpenAI and Oracle and the sort of circular financing that's going on there. There's a lot of revenue baked into future growth projections, and they really need to hit that in order to justify the financing that they're requiring to build out these super capital intensive uh, data centers and AI projects. Um, yeah, I mean, I think I mean, when you're talking about investing, you just need to be able to stomach the volatility. And right now, let's go back to the Qs chart. It's like we've just been in this big box since like October of last year. And that's kind of a long time. I mean, we had a sharp move upward from from the April rally of last year, like all the way from 400 to 630. So that was a huge move. So it makes sense that we would need some time to digest that. Uh, and what I mean by that is, as long as time passes, it gives these companies um, extra time to grow into their multiples. So, like when somebody says a company is overvalued, it could be, but it could also, like, as time goes on, they grow into that valuation. So, like, each quarter, if their earnings, if their EPS is growing, then the valuation will decrease over time. I mean, that's just how it works mathematically. So, like, after a huge move like that, a lot of these companies, you could argue, were overvalued. And then if we go sideways for 6 months or a year or longer, then the PE ratios start to look a lot more reasonable, purely just because time has passed. Um, so yeah, I think it's just so frustrating. Like the last couple days, we're just in this, not even days, months. We're just like in this box and we're not going anywhere. But I think a lot of it is because the AI trade got really hyped up, and there was a lot of investment pouring into those companies, and they went up a ton. And then the market just doesn't really know where to go after that. So we're kind of just floating around in this area. And then we had the Iran issue, so, yeah, I mean, we're just kind of stuck here. That's what it feels like. Just for a general market overview, it just feels like we're stuck here, and it feels like tomorrow is going to be a really important day to see how we close the week. And I mean, the other thing geopolitically is Trump hates to see the stock market go down. There's no question that he measures his performance by the stock market. So, that right now he's extremely angry that he's not being able to make the stock market go up. And I mean, on top of that, he only has a certain amount of time until the midterm elections. So I think he's trying to wrap this up as quickly as possible, but it's just hard to imagine a solution at this point to how they could actually accomplish that. And I mean, I think that's the exact reason why the market's selling off. But yeah, I think today was a big day. Tomorrow's going to be a big day, and then we'll see what happens over the weekend. I mean, again, hard to imagine how they could wrap the whole thing up over the weekend, but he'll definitely be looking to do it if he can. So, I mean, one thing that I've been doing personally is I've been buying calls for a day out, like 15 or 20% out of the money, just in case they wrap up some kind of deal here. Because once they do, the market's going to fly upwards. But that's just a small percentage, like maybe 10% of my put position I put in short dated calls, just to offset some of the losses from the puts if the market goes up, if you're following me on that. Um, okay, so that's it for the market overview. So some of the things that I wanted to discuss today was Amprius Technologies. That was the last email that I sent out for Altius Research, and in just a couple weeks, that stock moved up 100%. So if you bought that when I sent out that email, you would have made 100% on the equity. And some of the calls that I bought are up like 300 or 400% since then. But I've since sold those and restructured it just into equity at this point. But so what Amprius does is they make high density batteries for aviation, drones, and robotics. And they have twice the energy density of competitors, and they're extremely light too, which makes them an ideal choice for drones. They do an 80% charge in 6 minutes. And in my opinion, I think it's probably the best domestic uh, battery for these industries. And they manufacture domestically, but they also have factories in South Korea and China. And I think that that positions them well to not only benefit from the reshoring narrative, but also if I expect the Republicans to lose the midterms and the 2028 election. So if the tides change in the United States, a company like Amprius that has manufacturing domestic for uh, defense and prime contracts like that, that's essential. But then they also have the South Korea and China facilities where they could produce these batteries way cheaper, and they're well positioned in that regard. Uh, the other one that I wanted to talk about today was Robinhood, and that became my largest position this week. And the basic thesis for that, I mean, I won't go into the whole thing, but the basic thesis for that is that as wealth moves from the boomer generation into the younger generation, Robinhood's assets under management will naturally grow. They're well positioned within crypto and prediction markets, and they offer higher yield on cash than traditional banks. And I mean, personally, that's how I use it. It's incredible to be able to get over 3.5%. I'm not sure exactly what it is now, but to get that percent yield in a saving or checking account is phenomenal. So I think as time goes on, that's another one that'll grow into its multiple. I think it's at about like 65 PE right now. Um, but but yeah, I think as its assets under management grow, it'll be able to expand its revenue projections, and that's one that I love for the future. So I bought it around 25, and it got as high as like 150 last year, and I sold a bunch of it over 100, and I started rebuying it again in size last week when it hit the lows. The chart doesn't look great. It looks like it's kind of in a bear flag and it could take another leg lower here. But if it does, I'll just continue adding to that one because I think that that company is just going to continue to grow. Um, then the other one that I wanted to talk about today was I made a prediction market bet on Kalshi for the market is the 2028 Republican nominee for president. When I made the bet, JD Vance was at about 50% and Marco Rubio was at about 20%. So the thought process on that was that Rubio and Vance should be even money. It should be 50-50, in my opinion, on that. So I bought Rubio at 20. Yesterday, Rubio hit 32. So that was like a 56% move in just a couple days. It's back down to 28 now. But I mean, I think Rubio is more likely to be the 28 Republican nominee. I don't think he'll win, but I think he's more likely to be the nominee than Vance is because once you start thinking about who's more marketable in a general election, I think it's obvious that it'll be Rubio over Vance. So I was surprised to see Vance as high as he was, and the market is starting to change to reflect that. So yeah, I'll probably sell some of that when it gets closer to 50%, but I'll definitely hold some of it through and see if he actually does get the nomination. Because that was a really good risk reward bet from 20% chance there. So if there's any questions, I'll do my best to respond. Don't Please don't ask any personal questions, though I won't answer them. But yeah, I'll try to do this every couple days. And yeah, just to give you basically like a market overview and then just some of the stuff that I'm looking at. Um, yeah, and then we'll see how it goes from there. Okay. Thank you.